Good morning, everyone. This is Katie Novotny calling from Premier Marketing. I wanted to thank everyone for joining us this morning. We are thrilled to have Jon Thomas from Securian Financial here to discuss a couple things. First, he's going to discuss his life and long-term care combo product of Secure Care, along with some different sales ideas. One thing that we've noticed is we have so many different solutions that can fit a variety of people, but sometimes people struggle with knowing when and what to look for. So what we would like to do is go over a couple things, including ideas for your target market and when opportunity is knocking, when to take advantage. So that being said, Jon, you ready to take it away?
I am. Thank you, Katie. And appreciate you having me this morning. Thank you all who have joined. I'm thrilled to be able to present to you all this morning. And as Katie said, my name is Jon Thomas. I'm with Securian Financial. I've been with Securian for going on 2 years now, but have been in this industry with other insurance companies and for about a decade plus, primarily in the life insurance and long-term care market. I've become extremely passionate about elder care. As I've seen it in my own family and families of folks that I'm close with, and I'm sure many of you have had close personal experiences caring for loved ones, and you know how much of an important issue this is to address, right? But as we get going in our conversation, Katie really laid the format out well in the agenda for our conversation. I'll hopefully take about 30 minutes of your time, and then we'll have some time for questions. But as we get going, for those of you that are not familiar with Securian Financial, Securian is the parent company of Minnesota Life Insurance Company. You may be familiar with Minnesota Life. They've been around for 140 plus years. They are a mutually held company. And Securian is that parent or umbrella company over Minnesota Life, as well as the wealth management and asset management brands or facets of the company. So that's who we are. We're Minnesota Life Insurance Company. Securian really is just the umbrella name for the brand. But we are highly rated, and I mentioned we're mutually held because I think that's important for those of you that are thinking about adding a new carrier potentially to the solutions that you offer your clients. As a mutual company, we're not publicly owned, and we're less vulnerable, I think, to the whims of the market, to the ups and downs of the market. We really do invest conservatively, invest long term, so that we're around to deliver on promises in the future. Right, these promises of life insurance or long-term care, we need to be around to deliver on those promises 20, 30, 40 years down the road. And as such, we are fantastically rated. We've got a Comdex of 96 out of 100 that really puts us in the top echelon of insurance carriers. And so as you're evaluating doing business with Securian, you can be confident that we are a highly rated company that is stable and secure. All right. So as we start this conversation, Katie informed me that you all and many of you may have attended a webinar with Premier from Nationwide Insurance, a carrier that I'm very familiar with. I actually worked with Nationwide a few years ago, and a fantastic company. But I understand that Nationwide shared a little bit about changes in the market and COVID and how that's impacting the insurance market and impacting all of us really as people and as families and as consumers, right? And so we understand a lot of the market challenges prior to COVID. I know many of you know and understand the risks of long-term care. You've heard a lot of the statistics that you have a 50+% chance of needing some sort of paid long-term care. If you live beyond 65, that jumps to 70%. You've heard those type of statistics, right? But what we don't realize or haven't realized until recently is that concern has translated to the consumer. There's a fantastic report that Life Happens, the life insurance nonprofit organization in LIMRA, put out each year, and recently in 2019 was really the first year that long-term care expenses have permeated into the consumer mind as one of the leading financial concerns. As you see on the screen here, the 2019 top financial concerns, according to this report, is retirement savings, which many of you, I think, could understand, right? That first and foremost has been a leading top financial concern for most consumers. And then second to that is long-term care expenses. And from my understanding and my position, long-term care expenses and retirement savings are intrinsically tied together, right? That we know and understand that the biggest risk to successful retirement outcome is long-term care expenses and medical expenses in retirement. So I think consumers are beginning to understand that those two risks are really tied together. And as that report continues, it looks at the financial concern hierarchy, and they come up with an index. That index you see in a red dotted line there really is just the general concerns of consumers every day, right? Things like bills and expenses, or disability or life insurance, health expenses. And what you see here on this chart is that leading above just our general everyday concern and concern for expenses or bills, leading that is health expenses, right? Far and above just the general financial concern index are health expenses. And those health expenses are a combination of things. They really are health insurance, disability, just raw medical costs, and long-term care expenses. So it is a combination of those things. And that's probably why that's become such a topic in the last several years in political cycles. It's been a topic of politicians, right, to reform our healthcare system because it is a leading concern of consumers. As we looked at how those concerns are addressed, we have health insurance, life insurance, long-term care, and what you see here on this graph is the percentage of folks that have said they need this type of insurance versus folks that have this type of insurance. And so more folks actually have health insurance than they think need it, right? That's probably because of mandates and coverage through work, right, through employers, that we have adequate health insurance coverage. Life insurance, just about as many folks have it as they say need it. There's about an 9% spread between folks that have it and need it. Whereas long-term care insurance, believe it or not, roughly 55% of folks think they need some sort of long-term care insurance, but only 15% have coverage. And so that is a 40% spread between folks that think they need long-term care insurance and people that have it. That 40% spread actually is estimated to mean roughly 100 million Americans. So roughly 100 million Americans believe they need long-term care insurance and don't have it. And so that is from our perspective as financial planners, that is a significant gap in need, a significant gap in understanding of the solutions that are in the market, in a gap in what our clients are missing in terms of a financial plan, right? And so I think there's a significant planning opportunity and an opportunity to address long-term care insurance with consumers. Now, many of you are familiar with long-term care insurance. You've probably been familiar with traditional long-term care insurance, which is much like auto or home insurance, right, where you pay a stated premium, and that premium gives you a benefit. If you have a loss or a casualty, you get reimbursed out of that benefit, whatever your loss is. Traditional long-term care insurance is like that, right? You buy a policy, you pay a monthly premium, and it offers a stated benefit. One of the other solutions that has developed over the last decade plus is asset-based long-term care insurance. And asset-based long-term care insurance, unlike traditional long-term care, it is designed to be an asset within your portfolio, within your savings or retirement holdings. And as an asset, it is based on life insurance chassis, or designed on a life insurance chassis, to give several guarantees. It gives a guarantee of death benefit, a guarantee of long-term care, and it's designed so that you can reallocate some of your current investment, whether it's liquid savings or a CD or other assets that you have, reallocate into this solution, a portion of those savings into this solution, which using the power of that life insurance and long-term care coverage provides leverage and a large benefit for long-term care. And also an infographic for those of you not familiar with this type of coverage to really explain how it works. But why is having a plan important? And we talked about that a bit. If we look at a client's sample portfolio, let's say that we often look at these pie charts, right? And we have a large amount of investments. Those are generally qualified investments, whether it's a 401k, 403b, or other type of qualified retirement plan, right, or an IRA, and then we've got other tangible assets, our home, our car, and other things, and maybe life insurance and liquid assets. Those liquid assets might be in some sort of fixed instrument, a CD or bonds or other things, money market savings that are liquid, right? And so in this sample portfolio, if this individual is to have a long-term care cost, if they have to pay for elder care, what is their risk, right? Well, on this retirement portfolio, their income, let's say, is $80,000, and they need 60 of that to live, right? And what we understand about folks in elder care is even though they end up in a situation where they need care, their living expenses don't necessarily decrease. They still have a home, particularly if their plan is to stay home while they receive care, and they have other lifestyle expenses, right, that don't necessarily increase. And so if we add long-term care costs of $75,000 a year, we have a shortage of income, right? And it's really income that addresses this need. And we're going to draw that income from this portfolio, which is going to draw it down faster than intended. If it's not there in the qualified retirement part of the portfolio, we're going to have to potentially sell something or move around some money within this portfolio to make that extra income, right? And so instead of forcing this portfolio to deliver more income than intended, right, let's reallocate a portion of it. Let's take some of this liquid savings, reallocate it into a long-term care plan. And on this next slide here, we'll jump to this infographic. Let's say that that individual had a couple $100,000 liquid, and we're going to take a portion of $100,000 as a single premium. And that's going to create a couple of things when we reallocate it. That $100,000 is going to create, first and foremost, a death benefit. In this example, you see day one, $111,767. That is a death benefit should we not need long-term care or pass away before needing long-term care. That is a death benefit paid back to our investment, our portfolio. So it's really a return on investment. If we're not able to use it for what we intend it to be used for, long-term care, we do get back our money plus some. Now, that death benefit, if we need long-term care, it's accelerated for long-term care and used for that. And then once we use it up for long-term care, there's an attached long-term care policy that continues to pay. And this total benefit can create up to 6 years of benefit in this example for about $7,800 a month. Now, this example shows a 60-year-old that has an inflation growth built in, and by age 80, that benefit is a little over $600,000 of total benefit, which is what breaks down to the $7,800 or so a month. And so in structure, that's really how this works. Now, there are a couple of different ways you can design it, but this is a common design, is that we reallocate a chunk of our liquid assets into the solution, and it creates a death benefit and long-term care coverage. In addition to that, Securian does offer 100% return of premium after 5 years. So it is a liquid investment. Should someone cancel it after 5 years, there's a 5-year vesting schedule, and they can get their investment back. So that's important to note that it is 100% liquid or an ROP after 5-year vesting schedule. I mentioned some of the guarantees. Unlike traditional long-term care, this was somewhat developed to provide these guarantees that folks had concerns with, right? That if I die and don't get to use it for long-term care, what happens? Well, in this solution, there is that death benefit we mentioned. The long-term care benefits are guaranteed. As an investment, that premium is fully guaranteed. The premium is not going to change. And then if you want your money back, you can cancel it. In addition to a single pay option, there are multi-pay options. So it doesn't have to be funded in a one-time lump sum. This chart here shows the breakdown of options that Securian offers, whether a single pay, pay over 5 years, 7 years, 10 years, or even 15 years. And if we look at a 60-year-old, this will kind of give you a sense of how it's priced. We often use a 3% compound rider, and Securian is extremely competitive with the 3% compound rider. And we've highlighted benefits at age 85, which you can see in blue here. For a $100,000 investment on a 60-year-old, by age 85, it grows to $693,000. The 5 pay a little over $600,000. 7 pay about $584,000, on down to the 15 pay at a little over $500,000. Really, the power of these benefits. If you look on the right-hand side here, in this final column, we have a tax equivalent yield. With that 3% compound, that tax equivalent yield ranges anywhere from about 9.5% down to 10%. And so that's really the power of this solution. The question that comes up is, well, why couldn't I just invest this in something else? Why couldn't I invest it in the market, put that $100,000 in the market, and couldn't I do better? Well, you could potentially do better than 10%, right? In the market, you could earn better than 10%. You'd have to earn quite a bit more after taxes to get that same sort of yield, right? But the power of this, if we're reallocating out of our fixed investment, we're reallocating something that's going to offer a guaranteed 9.5% to 10% yield if we have benefits and file a claim at age 85 in this example, right? And so in no other type of investment can you reallocate your fixed portion of investment and get somewhere near a 9.5 or 10% guaranteed yield. And so because it's based on an insurance chassis and offers that guaranteed leverage, that yield, when we file a claim and when we start to pull income out of this solution, it is guaranteed. And so we can set our portfolio up to protect against this long-term care risk extremely well. And then once we protected this risk, maybe we can reallocate some of our other investments. Maybe we can invest a little bit more aggressively in our market investments because we have used this fixed portion of our portfolio to protect against this risk extremely well, right? So I think this is a powerful way of demonstrating why this solution really benefits the overall portfolio. Now, when we look at typical prospects for the solution, the typical prospect is generally someone between 50 and 68. The solution's available for anyone from 40 to 70. But we often write this on folks in their late 50s and early 60s. Actually, if you boil down what business we generally get, it boils down to about a 61-year-old female that invests about $80,000. Securian, as far as a carrier in terms of how we compare to some of the other solutions in the market, such as Nationwide or Lincoln, if you're familiar with Lincoln's product, we do compete extremely well on this single pay scenario. So reallocating a one-time payment into the solution, that's where we compete extremely well, and we're priced well for that. There are other carriers that are more competitive. If you fund a plan over 10 years or maybe 20 years, they're quite a bit more competitive there. So that typical prospect. And of course, these solutions are often positioned with affluent prospects, right? Affluent folks. So if you have those folks that are affluent, they're somewhat wealthy, this is a great plan to present with those folks. And often you get the question, right? Well, if they have the money, they don't necessarily need insurance, right? Well, having money doesn't mean you don't make a smart investment, right? This is an investment that could potentially leverage your investment dollar for 6, 7, 8 times your investment in guaranteed long-term care benefits. And so if we're looking to diversify our holdings into something that's really going to provide protection against this risk, it is a smart investment. And then business prospects. So the plan is designed to allow some deductibility, whether it's an S Corp or pass-through or a C Corp, and we're doing some executive benefit planning. These type of plans can be bought by a business and deductible to the business as a executive benefit to an employee. And so there's that can be a great prospect. And we're actually seeing a growing number of businesses that are offering this type of solution in an executive planning type of scenario. Of course, folks that have experienced long-term care in their family are great prospects. They've understand the risk and cost to their family, the emotional and financial cost, and are more willing to have a conversation about long-term care planning, right? And even younger or middle market prospects, and even expat prospects. So Securian's solution does offer 100% of the benefits payable internationally. And so we're one of the few carriers in the market that will offer 100% of benefits paid internationally. And so it can be an attractive option for folks that are thinking about retiring overseas and they still want to buy or plan for long-term care. This plan will pay them internationally. Now, I haven't mentioned yet, but I'll mention here that Securian does offer a cash indemnity plan. For those of you that were on the call with Premier and Nationwide recently, you know that Nationwide is also cash indemnity. Securian and Nationwide have very similar benefits in that we do offer a cash indemnity plan that will pay really as income and not a reimbursement of loss like traditional insurance. Right. And so as I think about retirement, we often plan for phase one of retirement. Right. Phase one of retirement is really the exciting part of retirement that we all look forward to. We think about stop working and traveling or playing golf quite a bit more often and hanging out with family and friends. Right. That is the part of retirement we think about. We don't plan for phase two, which is what more and more folks are starting to talk about as we have this tsunami, the tsunami, silver tsunami they call it, or increasing gray population, right? We're talking more and more about what it means to age in place and what it means to need additional help as we age in place, and what it means to hire more caretakers, right, for our country, because we're estimating some caregiver shortages. So how are we planning for that phase two of retirement, right? Are we only planning for the initial set of income? Or are we planning to create a step up in income later in life? And is our portfolio set up for that? Right. So what about this latter half of retirement? Where will that additional income for elder care come from? And as I showed in the additional or in the first example, if we add secure care to a retirement plan, we'll use a concrete example here. Maybe we have someone that's investing in their 401k and done quite well, and at age 50, they're going to add a plan like secure care into their investing, into their retirement planning process. And so we add the secure care plan at 50. We're going to invest a little over $400 a month. Let's say $415 a month from age 50 to 65. So over that 15-year period, that's $74,700. And in this example, we'll use a 5% compound inflation rider, which by his age 85, with that inflation rider, the total long-term care benefits grow to about $938,000. And that equates to monthly long-term care of $11,500 a month for 6 years. And again, as a cash indemnity plan, that is paid as income regardless of the type of care, regardless of what the costs are for this individual. If they need care and they qualify for care, qualifying for care is not being able to complete what we call 2 out of 6 activities of daily living, things like feeding yourself, dressing yourself, bathing, transferring, getting in and out of bed, right? Not being able to do those things, or cognitive impairment, Alzheimer's or dementia. that triggers this benefit. And so that would be paid as income to meet that additional income requirement later in life. If we look at an older individual, maybe someone that hasn't started planning at age 50, maybe they've later in life at 65, they want to start planning. They can still fund this plan over a period of time. We looked at some of those shorter funding scenarios, the single pay reallocation. This example, a 65-year-old could do a 15-year pay, funding it at about $583 a month or $7,000 a year. With the same 5% inflation option, at age 85, they still have roughly $600,000 in total long-term care benefits. And so from funding it at 500 even up to 65 with an extended pay plan, there are still significant benefits and significant leverage on our investment dollar. And then another example for those wealthy individuals that maybe want to purchase a long-term care plan for their adult children. Let's take an elderly couple that has significant wealth and they're in the business of gifting their kids. Maybe they're going to give gifts of $15,000 a year to fall right under that gift tax exclusion on an annual basis, right? And maybe instead of giving some other type of gift, they're going to give their adult daughter this year, start funding that $15,000 into a secure care plan. So the elderly couple funds for their 45-year-old daughter $15,000 a year for 5 years. $15,000 a year for five years is $75,000. In a secure care plan on that 45-year-old female with a 3% compound inflation rider, by her age 85, it's grown to roughly $922,000 in total long-term care benefits. That breaks down to about $12,000 a month in monthly benefits for 6 years. So this is elderly folks funding on their adult child. If she were to pass away and not be able to utilize this for long-term care, her grandchildren would get an $88,000 death benefit roughly. Again, it's not the same type of life insurance leverage as a raw life insurance policy would provide, but it is more than what they invested and a little bit more than probably what they'd earn in a CD or some other low interest fixed investment, right? On top of that, again, it is liquid. Should they cancel it, they could get 100% of their money back, fully guaranteed premium and fully guaranteed benefits. All right, we've taken about 30 minutes. I want to talk briefly about the care management program that we offer to kind of pull these benefits together and pull these ideas together. What we understand about elder care is that it is a progressive care need, right? Very, very little do folks have a stroke or have an accident and need round-the-clock 24-hour care, right? It does happen, but more often than not, as I mentioned before, it is aging in place and finding ourselves at a point where we need a little bit of help day to day. And as the days progress, we need a little bit more help, right? To the point where family and friends can't continue to provide support and need to bring in a caregiver. And as we bring in a caregiver and then look to assisted living or look to a round-the-clock facility, right? Those services are difficult to find. They're difficult to find. It's hard for families to vet out services or vet out caretakers or know who's a trusted person to bring into the home, right? And so having a care management program as part of the benefit to these solutions is powerful. One of the things it does with Securian is it, of course, helps policy holders and their families understand the benefits and receive the benefits, but it also helps them find local and vetted and trusted care services from, home care agencies or home care nurses or aides to assisted living to nursing home. It helps them find those sort of resources. In addition to that care management program is going to help them file a claim to start to receive their benefit. Part of that claim process with all qualified long-term care solutions is that in addition to not being able to do 2 of the 6 activities of daily living that I mentioned, or cognitive impairment, qualifying from a medical standpoint is one piece of it. The second piece of it is submitting a qualified plan of care. That's something that the Internal Revenue Code requires out of qualified long-term care benefit plans, is that the insured have a qualified long-term care plan. And primary physicians often are not educated in how to put together a plan. They don't do them very frequently. They're really not adequate at putting together a long-term care plan for clients. And so many folks have to go out and hire a geriatric care manager or bring in a specialist that can help them put together an adequate care plan. And so as part of this program, Securian actually has contracted doctors and qualified medical professionals that will walk someone through that process and help them develop a qualified long-term care plan that will meet the Internal Revenue Code requirements. And so we can actually guide someone through that so they don't have to hire an outside geriatric care manager or go to a geriatric physician that is different from their primary doctor just to have this part of the plan satisfied. And so that is a huge benefit as part of this care management plan. And so that really brings these benefits full service in not only providing that additional income, but then providing support as someone is aging, as someone maybe is losing memory, losing cognitive function. It brings that support to the family as they're going through this challenging part of their lives, right? So I'm going to pause here. And Katie, if you have questions that have come up, I want to make sure we get any questions addressed.
A couple questions for you. So we've had a lot of people sending in messages regarding funding. So do you take qualified funds? And
that's a great question.
Will you take a partial 1030? So basically, they're looking at funding ideas. So I've gotten questions on partial 1035s, full 1035s, along with qualified funds.
Sure. Well, we'll start with 1035s. So as a life insurance policy or a long-term care benefit based on a life insurance chassis, yes, we will accept 1035. And so you can roll over a full 1035 or even a partial 1035. We will accept it. Now, caveat there is it often depends on the carrier that has the life insurance policy that you'll be rolling it from. They really are the ones to determine if they will allow you to do the partial 1035. If we get the 1035 money, we will accept it, but it often is really up to the carrier that they have a current policy with on whether they'll allow you to roll out a partial 1035. So there's that. Now, as far as qualified funds, this plan isn't set up to accept qualified funds directly. What we often suggest is that if someone has maybe an IRA or other qualified funds, that you take distributions over a period of time. Maybe you do a 10 or a 15 pay structure. That way you can limit the taxable income in a given year and spread it out over a period of time. Or you can roll it into some sort of immediate annuity, maybe a single pay immediate annuity. You roll it over and can fund out of that over maybe 10 years to spread out a tax liability. So it doesn't take it directly, but if you spread payments out over a period of time, you can limit the tax liability. Yeah, good questions, Katie.
Perfect. One question I am getting is regarding the nationwide. So I will be sending out a copy of not only this presentation, but once you receive this presentation, if you did not see the nationwide to kind of put them together, just email me back and I would be happy to send those out. Another question for you, Jon, would be, can you elaborate on the tax benefits for business owners?
Yes, absolutely. You know what, and I may have a slide here, so I'll try to elaborate quickly on deduction potential. So depending on the type of asset-based long-term care plan, some of them are set up to allow deductibility or deduction on the long-term care part of the premium. The IRS Internal Revenue Code specifically prohibits deducting anything that comes out of life insurance cash value. And so some of the plans, like Securian's, have separated out the premium costs from life insurance and long-term care. And so because we've done that, the long-term care portion of those costs are deductible. And that's the base policy, the attached long-term care agreement, as well as inflation, all can potentially be deductible. But I want to caveat here, if you look over to the right-hand side, the IRS does limit. They give age-based limits on what's potentially deductible. So, for example, in 2020, an individual, if they itemize deductions, may be able to deduct up to $4,350 in a given year if they're between 61 and 70. And so there are these limits. Now, just briefly, I'll without going into too much detail, an individual can itemize and potentially take this age-based deduction. Someone that has a small business or an S corp, they can take this same age-based limit deduction, but it's an above-the-line deduction. It's a straight-line deduction. They don't have to itemize to get it. And so with those S corps or pass-through small businesses, there's a greater opportunity there. But when we're talking about corporations or C corps, there's far more opportunity there, because as a business benefit, a business can purchase the plan, and that premium cost is looked at as compensation. And as such, the business can deduct 100% of the premium. So if a business buys a plan for an executive, $100,000 single pay, they can deduct that $100,000 premium as a benefit to the employee. Now, the employee is getting this benefit from their employer, will have some income liability, some additional income that they'll have to claim. And they'll have to claim the portion of that premium that represents the life insurance cost of the policy. So in that example, if the business buys a plan for $100,000 and the life insurance cost is $40,000 and the long-term care cost is $60,000, as it makes up that total premium, the business can deduct the $100,000, and the employee has to claim the additional $40,000 of income. And so hopefully that makes sense. If you have questions, certainly, Katie, you can put folks in touch with me, and we can talk through some specific scenarios in a little bit more depth. But big picture, that's really the opportunities with either S corp, C corp, or individual deduction.
Perfect. Also, some questions regarding underwriting. Can you explain your underwriting process?
Yes, absolutely. So underwriting, this is intended to be a simplified underwritten product. And as such, unlike traditional long-term life insurance, there's not full underwriting where it requires a paramed, someone to come out to your house and draw your blood, or do a small physical. It is simply an application with a tele-interview. And that tele-interview is a phone call with a medical professional that's going to walk through a series of questions about medical history. And that medical history interview generally will last somewhere in the ballpark of about 40 minutes. For older clients, there's also a cognitive screen where they're looking for evidence of possibly early Alzheimer's or dementia. It's really a memory test that makes up about 15 minutes or so of that tele-interview. And so after that interview, Securian will either make an offer or decline that applicant. And so that simplified process really is someone goes through it and is either approved or declined. There are not multiple ratings with this product. There is the potential that if someone is declined, we may go after medical records to see if, after looking at their medical records, we can extend an offer. But in most cases, we're trying to underwrite someone specifically or only through that tele-interview and make a decision. So it is intended to be a fairly quick process and a simple process when compared to traditional life underwriting. I hope that addresses the question or helps.
Well, I think that we've handled most of the questions here. Jon, did you have any other slides you wanted to show us?
No, Katie. That really is the extent of it. I'm glad someone asked about the tax deductibility, because that was going to be my final portion of presentation. But appreciate the time, Katie, and as you look at these solutions and the carriers in the market that offer different products, there are a lot of similarities. There are some differences. Some of them are reimbursement. Some of them are cash indemnity. If I highlight Securian and where we fall within the different solutions, we are a cash indemnity solution. We're designed to offer this tax deductibility, and I think we have fantastic wraparound services like the care management program that I mentioned, as well as being extremely competitively priced. And so that's really where we focused our solution is consumer-centric solution that is simple and competitively priced and offers deductibility. So that's really, if you think of Securian and where we fit within these solutions in the market, that's how I describe us in a nutshell.
Perfect. Well, Jon, again, thank you so much for joining us. I really appreciate all the information. I know we went over quite a bit. I will, again, be sending out a copy of this presentation along with a couple marketing ideas and pieces that we have. Please feel free to give me a call with any questions that you may have. We do want to make sure that we are answering all your questions, and maybe you didn't have time to type in here, but please phone me, email, however we need to do it. If it's something that maybe I can't answer that would be specific to SecuriCare, I'm sure Jon would be happy to get on the phone with us and walk us through a process. I am also getting questions on training required to write the SecuriCare product. I would be happy to send out the CE information. Jon, did you want to address this one's specific to California before we let everyone go here? This would be
sure.
What trainings would you need in California?
Yeah, no, that's a good question. I'm glad you asked it. Unfortunately, at the moment, we don't have the solution in California. The product's not approved by California just yet. And so let me caveat there and say that we've got the product in every state except California and New York at the moment. And so it is important to make that known. We're in the process, I think, the final leg of approval in California, and so we should have it soon. And so, look out for news from us, but it's not there quite yet. But with each of the states, there is a long-term care CE that's required. And once it's approved in California, that LTC CE is going to be required as well. I think most of them require an 8-hour course, and California is similar in that requirement.
Perfect. Eugene, I know you're asking these questions, and I will reach out to you. We do have some different opportunities in California. Like Jon said, unfortunately, nothing with SecuriCare yet, but hopefully that'll change. And in the meantime, though, I will reach out to you as well. So, again, thank you, everyone, for joining us. Jon, thank you. We much appreciate you taking the time. And
thank you,
there,
Katie.
I will be reaching out to each and every one of you. Alrighty, everybody have a great day.